Hello everyone, my name is Prajwal Patil. I am studying MMS in SAS Institute of Management Studies, Boisar. In this video, I am going to talk on top-down and bottom-up approach in subject analysis of financial statement. So let's start. Top-down versus bottom-up approach. So first take an overview. Top-down and bottom-up approaches are methods used to analyze and choose securities. However, the terms also appear in many other areas of businesses, finance, investing and economics. While the two schemes of common terms, many investors get them confused or don't fully understand the difference between the approaches. Each approach can be quite simple. The top-down approaches goes from the general to the specific, and the bottom-up approach begins at the specific and moves to general. These methods are possible approaches for a wide range of intervals such as goal setting, budgeting and forecasting. In the financial world, analysts or whole companies may be tasked with focusing on one over the other, so understanding the uniqueness of both is important. So instead of a tidy bow, here 5 key takeaways from the topic. First one, top down usually encompasses a vast universe of macro variables, from bottom up is more narrowly focused. Top down investing strategies typically focus on exploiting opportunities that follow market cycle. Bottom up approaches start with local or company specific variables and then expand outward. Fundamental analysis is an example of bottom up investment approach. While top down and bottom up are distinctly different, they are often used in conjunction with one another. Understanding top down and bottom up approach. In a top down approach, you especially adopt an EIC approach to investing. In that EIC approach, you refer to the economy and you first take a call on whether the domestic and global economic scenario in for investment. Once the economic condition is satisfied, then you accuse the I, which represent the industry in which the company operates. You look at factors like how the industry is growing, what are the impact costs, what are the output price trends, entry barriers in the industry, etc. Once the investor is convinced that the strategic and opportunities outweigh the threats and weaknesses of the industry, then you move to the last step. C refers to the specific company where you propose to invest and that which has passed the economy and industry test. Then you drill down to financial like probability, profitability, solvency, liquidity, efficiency, valuations, etc. It is based on the ENC approach that the top-down approach is implemented. Bottom-up approach. Here the investor first analyzes the company, followed by the industry analysis and finally the economy analysis. If the investor believes that if the company has good fundamentals, then the reveal of the industry and economy is secondary. They identify an overall company and make investment accordingly. Where can top-bottom approach work well for investors? The top-down approach works very well in case the market is being largely driven by macro factors. Let us take some particular examples. Back in 2008, at the peak of Lehman crisis, all the asset classes across the board and across the world were crashing. Similarly, in December 2015, when the US Fed hiked Fed rates for the first time, equities across the world lost nearly $30 trillion in terms of market capitalization. In such instance, as a top-down approach can work very well. Another case in where the market are quoting at salvating valuation. Take the case of mid 2002 and March 2009, where the Nifty was quoting around 11 p.m. In such circumstances, a top-down valuation agreement is a good enough to buy stock. Top-down can work well here. Another case is where the key trigger for market is a global event. It could be the Greek crisis, the oil price crash, or even the bit on Eurozone. All these are macro stories where the top-down approach can work pretty well. Instead of focusing on top-down versus bottom-up investing, it is more important to understand which method works better in that circumstance. Understanding top-down investing strategy. As the name suggests, the top-down investing strategy starts from the top. Here the investors start analyzing from the top level or a macro level. The investor will start analyzing the economy, followed by the industry, and later the company. At each level of investment will take place according to the goals and risks appetite of the investor. In simple words, the focus of this strategy is on the macro elements. This investor identify alternative economies and later attractive industries within. Later, from the respective industries, the best available company is selected. Here, investors give due weightage to the economy and the industry segment, besides focusing on the best performing companies in that segment or sector. When does bottom-up approach work well for investors? The basic difference between top-down and bottom-up approach is that the latter is more stock specific. The argument that stocks can be economy agnostic and sector agnostic is true most of the time, if not all the times. There are some basic rules that one need to follow. In times of high quality, we ask about 25. Your bottom-up approach may not really work as the focus shift toward predominant macro risks. On the other hand, mid-cap stocks are more amenable to bottom-up approaches than the top-down approaches. That is because most mid-caps operate on a unique set of economic drivers, which are not exactly connected to the broad macroeconomy. We have seen stocks like Britannia and Lupin give multi-bagger returns between 2010 and 2013, despite the markets being tepid overall. Understanding the bottom-up investing strategy. As the name suggests, the bottom-up investing strategy starts from the bottom. Here the investors start the analyzing from the bottom level or from the macro level. The investor conduct analysis at the company level, followed by the industry and at the end economy. This strategy focus on the micro level element. The investors will analyze many companies on the basis of fundamental and will select the best suitable company. The investment vehicle's goals should match with the investor goals. Here I create one chart to understand top-down approach and bottom-up approach easily. An EIC analysis strategy. In top-down approach, the method comes from top to down level. First, they analyze of the economy and the market, then analyze of the economic sections or industry, then analyze of company. And opposite, bottom-up approach start from the bottom to top side. They first analyze of company, then analyze of economic sections and industry, and then analyze of the economy and the market. I hope you understand in simple way. Thank you so much.